Hello, everyone. Welcome to the third quarter NEPC webinar to cover our market outlook. I am Phillip Nelson. I'm joined by my colleague, Jennifer Appel. Before we get started, wanted to cover a couple logistics items for everyone before I forget. First, if you have any questions during the session, please enter them into the chat box and we'll try to get to everyone's questions at the end of the webinar in about 25-30 minutes. And then second, if you do want a copy of the slides or recording, these will be made available on NEPC's website at NEPC Insights, likely tomorrow morning. So before we kind of get into it, kind of just give you a quick preview of what we're looking to cover. I'll spend a little time talking about kind of last quarter and the state of the markets. And then we'll hand it over to Jen to do a deeper dive into the Fed and monetary policy, and essentially what does a long and variable lag mean for the economy? That's a term we're going to hear quite a bit. And then I'll wrap things up discussing our thoughts on both near-term and long-term positioning for portfolios. So why don't I get into it and we will get started. So as we look at this last quarter, it's pretty stark kind of what we're seeing in terms of performance. You can see kind of almost all risk assets were negative, safe haven assets as well. This is a pretty classic kind of type profile that you see when real rates are rising, especially in the fashion they did, over the course of the third quarter. And the outliers being kind of the dollar and commodities, which tend to be, commodities are linked to the dollar, and the dollar is linked to rising real rates or rate differentials relative to other parts of the globe. So this is a trend that we may kind of continue to see as we see more pressure on rates and higher real rates, and something we'll certainly be keeping an eye on. And as we look at kind of the rate movement for this last quarter, it's one of the more significant moves that we've seen over the last 40 years. So what we have here is the top 15 changes in terms of rate increases with the 10-year since 1980. So to some degree, we had to cut out some of the data points from the late 70s where, much more volatile rate environment because of the stagflation period. But as we look at kind of some of the data points here, you can see, 1987, 1994, some of the more kind of, dramatic rate reversals that we've seen over the last 30 years, and also some of the periods coming out of QE, and whether it was a false start in 2004, and also kind of late as we kind of move off a zero interest rate policy. And as we look at kind of the yield curve in general, is something we've talked quite a bit about over the last several months. We've had a deeply inverted yield curve, and we've seen that shift a bit in the last couple of months. And there's two thoughts on this. One is we're seeing a bear steepener where long rates are rising. Some of that's tied to inflation expectations, but some of it's simply just real rates rising. And there's two opposing thoughts on this that will probably not get settled for another 12 months or so. Historically, when you have an inverted yield curve and the curve starts to steepen, that tends to be a signal that maybe a recession is coming on. But also at the same time, when you look at kind of the current state of things, which Jen will get into in more detail, you can see that maybe this is simply just a normalization of interest rates. We're moving out of the period of central bank control from the last 15 years, and a flatter or healthier looking yield curve maybe is coming our way, especially if inflation expectations stay a little sticky. And as we think about what are some of the causes of this, largely it's related to not necessarily Fed funds, the action around Fed funds, but really around the guidance, kind of thoughts on a U.S. recession. And as we can see over the next 12 months, Fed funds is well above 5%, and largely some of the recession concerns are getting kind of squeezed out, kind of that front end and midpoint of 2024. Before we start to see rates come down a bit. And I think just a quick trip back in time to mid-March following the collapse of Silicon Valley Bank, you saw these Fed fund expectations completely collapse, where rate cuts were being priced in for 2023, which is certainly not going to happen. And in our mind, unlikely to occur in the first half of 2024 as well. And the bright spot on one note of this is we are seeing core inflation start to slow a little bit and moving closer to the Fed's target, this being core PCE, which is their the main data point the Fed looks to. And so in some ways, maybe this gives a helpful data point that maybe the Fed won't be raising rates dramatically over the course of the next 6 months, or in a pace that we've seen the last 12 months. I think many of us certainly hope not. But there's also some signals that says the Fed may just sit here for a while, as they wait for inflation to, fully stabilize around their 2% target. And at the same time, we're still seeing some data points, especially in prices of services, still being too hot for the Fed in terms of where they'd like inflation to be moving towards. So in some ways, a higher rate bias is certainly built in to the Fed expectation, and we think they're going to be fairly cautious over the next 12 months in terms of how they're going to be managing interest rates. And this clearly flows into market pricing around equities and other asset classes. And interestingly enough, this has been a fairly strange year for S&P 500, where we've seen a small number of companies really dominate performance for the year. So looking at the top 5 companies in the S&P relative to the rest of S&P, you can see in those that dark blue, and it's really heavily weighted towards the top 5 companies driving performance, and really seeing a fairly flat and kind of lagged benefit from almost the 495 other names in the index. And this profile is true when you go down to mid caps and small caps as well, where the breadth of stock returns has been relatively poor in U.S. markets. And we don't often talk about kind of equal weight S&P 500 index, but it's a useful tool to take a look at, how are we thinking about, U.S. stock returns. So looking at the profile of equal weight relative to the S&P 500, you can see on a trailing 250-day basis, the S&P's, meaningfully outperformed over the course of this year. And, we're approaching points that we've seen during, the pandemic, and also, the late 90s at the height of the dot-com period, where a small subset of stocks or mega cap stocks are dominating the market environment. And history says this mean reverts, but also history says it doesn't often happen quickly, and this can persist. And so this is clearly something that we're mindful of, and heavily influenced by some of the conditions we're seeing in tech names, Nvidia, Microsoft, Google, for example, in terms of kind of the outlook for them, both from a regulatory perspective and some very rosy scenarios from a earnings expectation standpoint. And as we look at kind of market sentiment outside the U.S., it still remains quite poor in China. We're very much waiting for a more substantive stimulus package to really help shift a little bit of the mindset and the sentiment in that market, and help kind of boost both stock returns and potentially give a little liquidity injection to that economy. Something I think many of us have been waiting on and hope to see in the coming months, but certainly something we're mindful of in terms of what is the state of China's economy, both from a market standpoint, a currency standpoint, but also just kind of a sheer GDP and its impact on the globe. And one thing that's clearly having an influence outside the U.S. is movement in the dollar. We're not at heights of dollar strength that we saw at this time last year, but often when real interest rates rise, and importantly when interest rate differentials widen between the U.S. and other markets, so think U.S. rates relative to Germany, U.S. rates relative to Japan, you tend to see currency strengthening occur for the U.S. dollar. And that's clearly something we're seeing today. So as we think ahead, and the potential for 1-2 hikes coming out of the Fed, maybe a pause or no movement out of other central banks, the prospects for a stronger dollar are certainly there. And for the investors that do hedge currency exposure, we're encouraging, moving some of those targets, more in line with kind of long-term targets that have been set. And you can see some of the impact on China's currency. Just partially this is as a result of rising USD. Partially some of this is sentiment, but also some of this is the central government letting the currency guide lower. Essentially provide cheaper exports as they look to sell goods overseas. But as we think back, over the course of the last 15, 20 years, more destabilizing moves in China's currencies tends to have an impact on emerging markets. So a kind of muted decline in the currency is something that's maybe not for concern, but more volatility, kind of big shifts and gaps out in the currency is something we'll have to be mindful of in terms of how that impacts broader kind of emerging market sentiment and kind of European equity market sentiment as well. And one thing that I think would be amiss, really need to, spend a couple of minutes just talking about some of the events in the Middle East, and don't want to over anchor on the price of oil, but, with, Hamas's attack on Israel, clearly tensions are going to be much higher in the region, and, concerns of a wider conflict are going to be, a focus for many. And, as we think about the price of oil today, it's, roughly in line with a relatively healthy kind of US economy. But as we think about kind of the global infrastructure for oil and, obviously proximity in Middle East, certainly concerns to be had on the price of oil and how that may move over the course of the next several years. And thinking about what this means for a headwind for US consumers, for example. What does this mean in terms of energy transition and some of the transitions we're seeing to electric vehicles? And so when we think about some of these geopolitical events, often we'll see a quick hit from markets where markets will sell off following a major geopolitical event. And kind of our bias historically has been encouraging investors to rebalance into markets at that point. We're long-term investors, we're liquidity providers. There's often a good entry point to move in, as most geopolitical events kind of smooth out over time. But the macro importance of oil and its impact on the global economy certainly can't be ignored. So not a lot of new information here, but just a little signaling that this is something certainly to keep front of the mind as we see some of the events unfold. So with that, going to turn it over to Jen to dive a little deeper in terms of the Fed and monetary policy.
Thanks, Phil. So as mentioned in this section, we're going to walk through how we're thinking about the kind of ubiquitous long and variable lag, and separately why we think that it might look a little bit different today given some of the underlying dynamics that we have in the economy. But taking a step back, kind of echoing some of Phil's comments on how the Fed has changed interest rates and monetary policy, we are now about 19 months into a Fed rate hiking cycle. So we've seen interest rates rise significantly, 500 basis points or so, as you can see at the end of this chart. And it's also included some tightening or shrinking of the Fed balance sheet as well. But even with this significant change in the monetary policy backdrop and the tighter conditions that are generally associated with that, the widely anticipated US recession has yet to formally arrive. So that's something that if you've been listening to our webinars, we've maintained that a recession was unlikely this year, despite some of the key economic indicators like the inverted yield curve or the leading economic index that continued to flash clear recession signals. And now looking to some of the continued resilience in the US economy, we continue to view a recession as unlikely in 2024. So with that in mind, we wanted to explore why haven't we had a recession just yet? Conventionally, when you think about the long and variable lag, it is about 12 to 24 months, and we're kind of right in that window. So we wanted to walk through some of the data points that make us question that lag a little bit, since we're not seeing the economy act as it has historically when rates have risen by this level. So first, looking here at the composition of the US economy, the share of goods and manufacturing in GDP, employment, even consumer spending, all of that has shifted over the last few decades in favor of services. Now, thinking about manufacturing for a moment, this tends to be a very capital intensive industry that's often among the first to react to rising rates, given that there's significant sensitivity to financing costs and to capital expenditures. And the other side of this is that rising rates are generally a negative for demand for many of these goods, as consumers will often finance large purchases of appliances or cars, for example. So higher rates dampen the demand side as well. And that's in contrast to the services side. Services are generally less sensitive to changes in interest rates. So when we see this type of shift, it kind of points to a different reaction function for the economy relative to history. And we're seeing evidence of that when we look to aggregate spending or investment data as well. On the following slide, just looking historically, typically when we see interest rates rise, there is a sharp and almost immediately see a pullback in investment. And especially if you look around times where we had peak Fed funds rates, you'll see a pretty depressed impact on investment. So as we look to the environment today, we have some recent data that shows investment is recovering. And when that pace of investment remains strong, that can continue to support economic activity and even job creation as well. So should we see that investment continuing to pick up, that brings this idea of a lag into question. You know, maybe it's longer, maybe it's broken. And I think clearly time will tell if this is really a different trend relative to what we're seeing compared to history. Now, flipping forward a slide, one of the primary concerns that we have when thinking about rising rates is the impact on debt. You know, debt becomes more expensive, interest expenses will be higher, and we've seen interest rates rise a few hundred basis points across the curve, which will very acutely impact any outstanding floating rate debt or any entities that have a significant amount of short-term debt that will need to be rolled over. With that said, this is not an equal impact across the board, especially for companies that exhibit strong free cash flow growth or those that have operating leverage. You know, they should be able to weather this rising interest rate and inflation environment a bit better. So there is a little bit of a quality bias at play there. But the other interesting thing to maybe note here is that there's also a lingering impact from the interest rate environment that we had over the last decade plus. With rates so low for a sustained amount of time, you know, that was a favorable environment for debt issuance. So many corporations we saw refinancing their existing debt or even issuing new debt when rates were favorable. So it seems kind of an aggregate that many issuers have not realized the full impact of higher rates just yet, suggesting that maybe the lag time is a little bit longer than what we've seen historically. Now, looking to the real estate market, again, another highly interest rate sensitive part of the economy. The standard playbook here would say that when the Fed raises rates, we should see a demand impact as home affordability declines. And the result is that you have kind of not enough demand for the supply levels and home prices should correct. What we've seen today, though, is we have this negative impact on the volume of mortgage or refinance applications as rates have risen. So that side of the market is behaving as you would expect with the move higher in rates. But when we think about the home price side, we have yet to see a big correction. And in fact, in some areas, prices are now higher on a trailing annual basis. And we think this is really tied to the supply-demand dynamics that we have in the real estate market today. Generally speaking, inventory levels are low, as we show on the next slide. So there is this kind of natural scarcity in the market that is bolstering home prices a bit. And as we think about the impact of many homeowners that have mortgages that are well below current rates, that makes the hurdle for moving just that much higher, as potential sellers would need to swap their existing mortgage for a higher rate. And that substantial cost is likely to deter homeowners that might have otherwise moved. So we expect generally less turnover and less supply that can support prices perhaps a little bit differently than history. So ultimately, we don't see the typical conditions that you'd see that would lead to home price corrections, but the kind of recession risk here that we'd like to highlight, that would come about if we saw a change to the income profile of homeowners. So think about an event like job loss or some severe impairment to spending ability that might create a forced sale situation. So that could certainly lead to some home price declines, but that hard landing path is difficult to see from where we are today. And looking here to the consumer balance sheet, a fairly healthy picture. There's not a lot of evidence when looking at debt to GDP ratios or debt servicing costs that consumers have overextended themselves. And this isn't the typical profile that you'd see heading into a recession where debts may be accelerating or discretionary incomes might be pressured. So some of this is likely reflecting the lingering impact of savings balances that had grown during the pandemic, and that dry powder has continued to support consumption overall. But with that said, it's likely that some of the narratives around headwinds in the near term, like student loan payments or rising credit card balances, some of that can start to take its toll. But we don't see any immediate signs here that we'll have a large pullback in the consumer, especially considering the pickup in investment that we highlighted up front. So we think that the consumer can kind of keep the economy rolling unless we get those large job losses or changes in income. And moving on to the labor market, even as the Fed has raised rates considerably, we haven't seen anything from the jobs market that suggests material weakness. You typically expect higher rates will influence spending and hiring plans, but we've yet to see that in terms of job losses, which is likely given the supply-demand imbalance today that we have with labor. With that said, it's important to remember that the labor market is more of a lagging indicator for a recession. So it is backward looking by nature, the data is lagged. But the data still is showing that we have a historically robust labor market. And as we think about what might cause this to change, it comes back to some of those data points we referenced. If we have rising interest costs that force layoffs or force cost consciousness by companies, if there's pullback in investment, those are things that could lead to the job loss scenario. But we would truly need kind of widespread job losses to push the economy into a recession, and there isn't evidence of that in the data today. So to bring that all together, we walked through a number of different data points on the economy today, and we've shown that many of them have weathered the shift to higher interest rates fairly well so far, which suggests that that long and variable lag idea, it might still be there, but it might be a bit different today. It perhaps could be longer and a little bit more variable. So all of these dynamics, I think, kind of point to the fact that rising interest rates don't necessarily automatically equal a recession. And with this backdrop, again, we are not anticipating a recession for the US in 2024. And some of the shifts that Phil highlighted up front in terms of the Fed dot plot or the market interest rate expectations reflect that squeezing out of recession concerns as well, given the resiliency of the underlying data. So with that, I'm going to turn it back to Phil to talk about positioning.
Great, thank you, Jen. We'll highlight some of these items relatively quickly. And just as a reminder, if you do have questions, please enter them into the question box on the top right, and we will happily get to questions at the conclusion of our prepared remarks. In terms of kind of our positioning views, and this reflects both kind of a longer term and also kind of a shorter term view as well across some of these views. First is thinking about U.S. equity markets and still encouraging kind of a reduction in U.S. mega cap exposure. Valuation profile still is a bit of an outlier, and we see some healthy prospects or good prospects in high yield corporate bonds, especially the ability to earn kind of an 8 and 9% yield in that space. When we look at credit spreads, they're roughly in line with medians, kind of range bound around then. So this is not a kind of pound the table spread charge, but really just reflection of relatively high carry with default assumptions already kind of built into it, offers a quite reasonable return over the next 2 or 3 years from high yield. Second point here is more of a reflection of the market environment, and as we see more macro volatility, shifts in interest rates, shifts in inflation, things that we saw kind of pre-2000s, it lends itself to being a environment that is better for active management. And so as we think about equity implementation, would very much encourage investors to kind of push more into global equity strategies and make greater use of active equity approaches. And as we think about just the market environment, I mentioned real interest rates are much higher and have normalized quite a bit. So we're really encouraging from a strategic lens, introducing U.S. TIPS to policy targets. This is not something that you're going to want to hold for 6 months, but we think TIPS have a vital place in a strategic asset allocation. And now that interest rates are normalized and we don't think they're going back to zero, we think TIPS have a permanent place in investors' portfolios at, let's call it a 5% allocation. And this is especially true for, I'd call it, investors with lower return targets, lower volatility profiles, where additional fixed income allows investors to kind of meet their goals in a more diversified fashion. And the last point is more of just a disclaimer of really encouraging having duration levels kind of in line with your policy targets. We don't want to be dramatically underweight duration at this point, with the 10-year hovering near 5. Certainly could move higher, but at this level of rates, we're starting to see little bits of value coming out of the interest rate forward markets, and are more than happy to be in line with duration levels. And again, this is especially true for investors that maybe have a more targeted return. So think of an LDI investor. This is, we believe, certainly not a time to be underweight your duration targets. So as we look a couple of slides here, we look at kind of S&P valuations relative to 10-year Treasury yield. So thinking about the earnings yield on S&P relative to rates, we've seen rates rise, quite a bit, but valuations haven't adjusted to it quite yet. And there's two paths for this to go. Prices can come down, which would quickly cause valuations to reset, or we could simply see earnings grow faster than prices grow. And so over the next couple of years, earnings growth could be relatively positive, relatively healthy, but prices move in a more range-bound fashion, and that's the pathway for valuation to adjust a bit over time. And then just to reinforce kind of my comments on TIPS, we've got a few fans of TIPS across NEPC, and any chance we can to show 5-year and 10-year TIPS earning more than 2% real yield, which we haven't seen in 20 plus years, is in some ways something to celebrate. And we think it's something here to stay. And we think about kind of forward-looking return projections for these type of securities. If theoretically, if you're owning a 2.5% real yield, and let's say inflation normalizes and we're something closer to 2.5 to 3%, that's a 5% plus return for TIPS. And if we see inflation move higher than markets project, that's straight through the bottom line on TIPS securities. And lastly, just mention for high yield, clearly still offers a carry benefit. And as we look at kind of high yield and cash, for example, we view them as luxuries for portfolios to have. If you have the ability to do so, having a bit more liquidity, having a higher carry is certainly positions that we'd encourage for portfolios. So with that, we're going to turn it over to Jen and dig into questions.
Thank you. So now we're going to open it to Q&A. If you have not submitted a question and would like to do so, please feel free to drop that in the chat box now. We do have a couple to get through, so maybe I'll start with tossing one to you, Phil. You highlighted some negative sentiment around Chinese equity markets, and the question is, has this influenced your positioning in the near term and also from a strategic perspective?
Yeah, it's, the results in China, I think, clearly have been disappointing for 2024. We expected, China coming out of kind of their COVID restrictions to have a more robust consumer response. We've seen a healthy level of consumer spending in China, but not to the levels that approach kind of what we've seen in Europe and in the U.S. in terms of kind of a kind of revitalized consumer. And many of the trends that we've seen in kind of the real estate sector, have been longstanding policies for the last several years, for the government to provide some controls in that space and kind of a higher quality level of growth. And so as we think kind of, short term, looking to get some stimulus that the government can provide that hopefully can start changing the sentiment and narrative for China and EM. But also, we need to see kind of consumption normalize and a return. And, an impairment to the consumer in China would challenge the long-term thesis. So that's something we're clearly keeping an eye on.
Great, thanks. So we have another question around the impact of higher interest rates on government debt, which I can take. We walked through a lot of the impacts of what that means from a corporate or even a household debt perspective, but it's fair to say higher interest rates will definitely impact the US government as well, and I think governments around the world as well, especially when you think about the fact that most of the debt that the US government holds is shorter term, something like 50% or so will be rolling over in the next few years, and current interest rates are 200, 300 basis points higher than they were. So we expect that there will be a big jump in net interest expense. And the concern with that is that the gap between spending and revenues will continue to rise simply because of the higher interest number. And it's not because of new spending initiatives in education or infrastructure, for example. And as that increases, of course, that impacts the fiscal outlook, especially given some of the concerns around the US government today and the potential for further shutdowns that are in the pipeline. So progress on this topic is going to be difficult, and it was kind of an issue that we knew was going to come up over time, and it has snowballed as rates have risen pretty significantly. So with that, we have one more question around tips. So maybe a little more context, Phil, on what duration tips and a little more on implementation.
Yeah, and so as we think about tips in general, we think this is a asset class that lends itself to a passive implementation, and one where the normalization of real interest rates provides a healthy cushion for tips in the long term. So should we see a recession, the Fed will have to cut interest rates a bit, and obviously falling real rates will benefit tips. But also at the same time, higher levels of inflation or stickier levels of inflation, will flow through and benefit tips as well. So we really like the diversification prospects of it. And looking at, either a full index exposure to tips, or, depending on kind of implementation or certain structures we see in target date funds and glide paths, an intermediate or 1 to 10 year tips also would be appropriate.
Great, thank you.
One more question, Jen, on private markets.
Sure. Yeah, it looks like we have one on just thoughts on private equity overall. We spent a lot of time talking about public markets. So Phil, maybe a little more context on what we're seeing in the private space.
Yeah, I mean, as we look at private markets in general, and our private markets team is commented on this and been providing some really good guidance in terms of how to be thinking about pacing and structuring private market portfolios over the long term. We're seeing kind of fundraising certainly slow down. We're seeing exit volumes and activity a bit slower. We're seeing a rekindling a little bit of venture, but certainly don't want to over extrapolate what we've seen this last quarter or so to anything close to the peaks that we saw 2 or 3 years ago. And I think the main kind of point of emphasis here is really to be consistent in your pacing structure. Assumption is liquidity tests have been done, your illiquidity profile is appropriate relative to your cash flow profile. And this is an opportunity to ensure that you're providing commitments to your kind of highest conviction managers, and also kind of long tenured relationships you have with managers. And we think kind of maintaining discipline is always kind of the course of the day in terms of private markets commitments over time.
Great, thank you. So I think we'll wrap up there. Thank you for those who joined today and for those that submitted questions. As mentioned up front, the webinar recording and slides will be available to you on the NEPC website, hopefully by tomorrow. But thank you again for joining us.